Good evening, everyone. Hearty welcome to all of you for this conference call to discuss the unaudited financial results of City Union Bank for the second quarter, half year, ended 30th September 2024. The board approved the results today, and I hope you all have received the copies of the results and the presentation. At the outset, our bank is completing 120th year of operation this year. I take this opportunity to salute all our predecessors who had laid foundation for our growth, and also thank our staff, our customers, and investor community at large who had shown great faith in our bank. The date of incorporation was 31st October 1904. In our Q4 financial year 24 and Q1 financial year 25 Concalls, we had shared with you all our expectations for our current financial year as below. With all the new digital initiatives supported by strengthened top senior level management, we could see visibility on growth front going forward. We are also looking for other avenues for growth and putting our best effort to reach the industry level growth as soon as possible in credit. Post MSME digital lending model will be expanded to secured retail lending such as housing, LAP, micro LAP. In our last con call, we had also stated that we are building capacity as well as human resources in order to support our retail credit. On asset quality front, we will continue with the trend of reduced slippages coupled with the improved recovery for the current year. Our ROA back at our long-term average of 1.5, and it should continue. Since we are taking the cost upfront, our cost-to-income ratio will be slightly higher in the current year, and once the benefits of digital lending and other initiatives transpire into growth, the CAR will start coming down. The reduced slippages and improved recoveries will help to maintain our PAT growth. These are all the points I shared with you all during Q4 financial year 24 and the Q1 financial year 25 con calls as the expectations for the financial year 24-25. For the current quarter and the current half year ended on 30th September 2024, we are almost on track on our points expectations which we shared with you all. We had registered a 12% advance growth for Q2 financial year 25 year on year, and our advance increased to rupees 48,722 crore from 43,688 crore in Q2 financial year 24. You may observe we restarted our growth at the beginning of 2022 post-COVID and reached the 14% growth for the December 2022 compared to the previous year 31st December 2021. The calendar year 23 was not good for us as we had to unwind our KCC gold portfolio among other things, and growth for December 2023 slipped to 2% compared to December 2022. We restarted in January 2024 and reached double-digit growth for June 2024. Also on a sequential basis, that is compared to 30th June 2024, our advances had increased by more than rupees 2,100 crore or 5% growth in Q2, and we had achieved the double-digit growth consecutively in the last two quarters. We had seen considerable improvement in our efficiency levels of credit sourcing along with the digital transformation as resulted in reasonable credit growth. Our plans in pipeline like retail vertical and other avenues in advances will support us in terms of our credit growth once they are all taking a shape. Actually, if you speak, the current credit growth is achieved only with our traditional business lines like MSME, gold loan, etc. Actual incremental credit growth from the retail and all are yet to start. So whatever growth we have achieved so far, this 12% is basically from our core business which we had done in the past. Our deposits had grown by 9% and stood at 57,369 growth for Q2 25 as compared to rupees 52,714 crore for Q2 financial year 24. In Q2 financial year 25, our deposits has increased by rupees 2,512 crore or 5% growth in the current quarter. So the average CD ratio for Q2 financial year 25 stood at 84%. Cost of deposits stood at 5.73% for H1 financial year 25, which is almost similar to the last quarter, that is Q1 financial year 25. On asset quality front, as we stated earlier, the trend of recoveries over and above the slippages is continuing. For Q2 financial year 25, the total slippages is 176 crore, while the total recoveries is rupees 265 crore, consisting of rupees 201 crore from live NPA account and 64 crore from the technically written off accounts, resulting in the slippages falling below the recoveries. For the half year ended financial year 25, our total slippages was 354 crore as against 607 crore in the first half last financial year. On the other hand, our total recoveries in H1 financial year 25 is rupees 501 crore, consisting of 393 crore from live NPA accounts and 108 crore from technically written off account. As a result, our gross NPA percentage has sequentially decreased from 4.66% on last year 30th September, 4.47% in Q3, that is December 2023, 3.99% for the 31st March 2024, and 3.88% in 30th June 2024, and now further reduced to 3.54% for the current quarter, 30th September 2024. Similarly, our net NPA number had reduced to rupees 175 crore and net NPA to 1.62% in Q2 financial year 25 from 2.34% in the same period, Q2 financial year 24. Sequentially also, it has decreased from 1.87% on 30th June 2024 to 1.62%, that is 25 basis point reduction in the net NPA percentage for the third quarter currently. We conveyed that expected slippage in the financial year 25 would be about 800 crore during Q4 financial year 24 Concall. We are on track. As per the trend, we should be reaching between 1 to 1.25% net NPA for the year end. We understand that we are outliers in the provision coverage ratio. We will explore the possibilities of increasing the provision coverage ratio also this year. Our interest income had grown by 10% in Q2 financial year 25 and increased to 1434 crore from rupees 1304 crore in Q2 financial year 24. Our yield on advances stood at 9.81% for Q2 financial year 25 against 9.77% for the same period last year. Our net interest margin for Q2 financial year 25 had improved to 3.67% as compared to 3.54% in Q1 financial year 25, and for H1 financial year 25 it stood at 3.60%. Looks like the interest rate reduction cycle is some time away. As discussed in the earlier call, the margin should be at 3.6% plus or minus 10 basis point as we discussed during multiple times in the past. Our cost to income ratio for Q2 financial year 25 had reduced to 47%, 47.06% as compared to 49.34% in the Q1 financial year 25 and 51% in the Q4 2024, showing a sequential decrease. During the earlier calls, we had said that we will see reduction in the operating profit, but we will manage the PAT with the help of reduce the credit cost. After 6 quarters or so, we have started seeing operating profit also showing a growth as business has started showing growth which is also getting converted into improved operating profit cycle. So coming to the cost to income ratio once again, the cost to income ratio reduced in the current quarter due to reasons like
Ladies and gentlemen, we have lost the management line connection. Please stay connected while we reconnect them. Thank you. Ladies and gentlemen, thank you for patiently holding. We have the management line back on call.
Yeah. Sorry, there was a call there. Once again, you could see the coming back to the cost to income ratio once again. We saw the cost to income ratio for the Q2 coming down to 47.06% from 49.34% in the Q1 financial year 25. It was 51.26 in the Q4 financial year 24. Basically, we said the cost to income ratio will start coming down from the 50% and we are seeing some traction. But this time the impact was more because we could see the loan processing charges significantly improving from 23 crore in the first quarter to 38 crore in the second half, which also contributed for the reduction in the cost to income ratio. Similarly, compared to last year, interest received from the income tax refund, last year first half it is about 9 crore, which increased to about 40 crore in the first half. So as suggested in the earlier Concall, we should start seeing the cost to income ratio moderating between 48 to 50% going forward and then showing a continuous decline. Our ROA for the first half is at 1.55% compared to 1.54% in the corresponding period last year corresponding period. As stated in the earlier Concall, the ROA is stable for the past for the few quarters, and we should be able to things stabilizing and probably inching up going forward. Overall, SMA 2 to the advances currently stands at 2.03%. As we have been discussing in the past, we are seeing the number coming down. So we had achieved a PAT growth of 8%, that is current PAT for the H1 stands at 550 crore against the 508 crore for the H1. There is some base effect because the year before last we had a very high profit in the PAT in the second half, so which is getting maintained, but overall you could see a significant increase from Q1 to Q4 also, and we are able to see things stabilizing going forward. As per the latest LCR guideline, our LCR is calculated as 121% for the 30th September 2024. We had taken steps both on liability side and asset front, going for some non-callable deposits, converting some foreign currency deposits on maturity into liquid securities and things like that. So to sum up, our efforts so far had helped us to push our advance growth rate towards the industry growth rate. We will, as I told earlier, the growth so far has come purely from our traditional MSME and gold agricultural and all. The new retail vertical and all, we are in the process of building that. And once they come into the picture, they should be helping us to get some more incremental advance growth. We are confident to restore our credit growth on par with the industry level sooner and go beyond. Our growth has started showing visibility on achieving our particularly better NII growth and operating profit growth also. So both NII and operating profit growth was muted, or even we saw few quarters of subdued NII and operating profit in the last few quarters. Now we have started seeing the visibility in terms of seeing both NII and operating profit to grow, so that which will be helping us to have a stable profitability as we move forward. We will reach between 1 to 1.25% net NPA by the year end is our current visibility, and we are exploring the possibilities of improving the coverage ratio as we will be in a position to get a clarity as we move into the second half fully. We expect our margins, cost to income ratio, NPA slippages to stay stable around the numbers communicated to you in the earlier con calls. And finally, we are seeing better visibility on growth numbers from our conventional areas, and new avenues will definitely help us to add extra growth numbers which will be available going far in the future. So basically, this is what I wanted to communicate. With this, I will probably take a break, and I open to you for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mona Khetan from Dolat Capital. Please go ahead.
Yeah, hi sir, good evening, and congratulations on a good set of numbers. So my first question is around the new retail product initiatives. So have many of these products already been introduced? And from a full year perspective, if you could guide what sort of growth we are expecting.
See, as told in the earlier call, the things are being now put, the systems have taken in a shape, writing the policies, training the people, having the people in place. All these things are now taking a shape. As explained in the last quarter, some amount of contribution to the business will start coming from the fourth quarter onwards. The significant contribution you will start seeing in the next financial year. As of now, as I told, we have started taking expenditure on that front, but the business and income is yet to start. So the preparatory works are underway.
Sure. And from a full year for the entire book, what sort of growth could we expect for FY25?
Yeah, this question was asked again and again in the last two Concall also. I refrained from giving a number. So you have started now. When I gave that number and all, I did not have anything to support, and now you have started seeing the improved credit growth both in the first half and second half, and numbers are framing up. And we are taking all our steps to ensure that we touch the not less than industrial growth rate, and probably a small growth over and above that before the year end is what we are trying to aspire.
Okay. My second question is on this NBFC book that you have. So if I look at the last 2 quarters, the growth in this book, the book has grown by over 15% sequentially, the book where you lend to NBFCs. Now, I understand there's a very competitive segment. So what is helping this growth, if you could throw some light around it?
See, basically, like we have the current level of NBFC, like as you see, between the 30th June and like say, so our incremental NBFC book for the 30th September is about 315 crore. Year-on-year growth on that front is about like say 500 crore, and you have some repayment also happening in that portfolio. And we have not compromised that yield on that, like say it is closer to the average 9 to 9 point. The average yield of the portfolio is just under the our average yield of 9.7 is the average yield, and the portfolio yield is also closer to that.
Sure, sir. Got it. Thank you. I'll come back in this week.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of M.B. Mahesh from Kotak Securities Limited. Please go ahead.
Good afternoon, sir. Sir.
Yeah, good afternoon, Mahesh. Yeah, go ahead.
So just this yield on advances which improved this quarter, if you can just kind of highlight what's happened there.
Basically, we looked into the yield of gold loan portfolio, which we tweaked in the last 3-4 months, which works out about 20% of our portfolio. And also, like as we had been discussing, like we could last year when the rate of interest increasing cycle was happening, we could not transmit a portion of that. So keeping that in the mind, we are closely looking into the books which is coming for the renewal, and we are able to like say see some amount of like say transmission in that also. So that has helped us to see some amount of like say a few basis point improvement in the yield.
And this will continue through the rest of the year, given that not everything would have repriced.
Till probably the decreasing interest rate cycle starts, we will be in a position to go for this like say a review of the rates and take a call in tune with our expectation of overall strategic intent, particularly on the net interest margin.
Sure. Second question on this recovery from written off, about 95 crores has come in the current quarter. Sustainability at these levels?
See, the by and large, the total recovery numbers will be like say plus or minus 20-25 crore. We don't, when we take effort, we don't differentiate between which is live and which is technically written off and all. So the what happens? I mean, the efforts for both the technically written off account and the live accounts are the same. So if we recover live account, it will reduce in the what you call provision. If the recovery happens in the technically written off account, it will be the other income. So the balance, it is very difficult to exactly predict how it will happen.
No, in the sense the environment for recovery still looks to be fairly healthy. No,
Absolutely.
And last question, sir. You had indicated that net NPA will come down to about 1.2 by the end of the year, is it?
Yeah, for the financial year.
And if you don't reach that number, you will have to take you intend to make a higher provision. Should we look at it that way?
See, with the visibility, whatever we are getting in terms of the slippage and the recovery, we are giving this. And like say, you cannot make a clear-cut thing whether like how it will happen and all such things. We have to wait and see how it happens. So similarly, like like increasing the provisional coverage ratio or having the net NPA and all are finally like say if you reduce the like say increase the provision, the net NPA will decrease and final profit will be there. if the, this trade-off, we have to take a call on an ongoing basis. That is based on the current level of policies, whatever we had been looking into, based upon the trend in recoveries and the visibility in slippages, this is what we are expecting at this moment of time. Any change in the expectation, we will communicate in the subsequent con calls.
Perfect, sir. Done. Thank you.
Thank you. The next question is from the line of Abhijit from Axis Mutual Fund. Please go ahead.
Thank you for taking my question. So first question is on deposit growth. How do you see liability situation for City Union Bank and the cost of deposits?
See, it's stable as we could match the credit growth with the deposit growth. There were some 33 days with about 7.5% rate of interest and all. We had to introduce the scheme and all. So we could see the.
Ladies and gentlemen, we have lost the management line connection. Please stay connected while we reconnect them. Thank you. Ladies and gentlemen, thank you for patiently holding. We have the management line back on the call. Yes, sir.
So basically, to continue with your answer on deposits, we don't see any, tension over there. We were able to match the deposit growth in tune with the credit growth, and we feel we should be the current cost, whatever that has been observed, should continue for the second half of the year also by and large.
Sure, sir. So what is the LCR as of September end?
121 or something, which I gave during the call.
Sure. Sir, just one observation. In the sectoral deployment of loans, the loans breakup, the loans to the trade, retail trade and wholesale trade, that continues to reduce every quarter. What is the issue here?
See, the trader segment, if they get the MSME certification, it gets repriced, recalibrated as the MSME thing. It depends upon the Udayam registration. The explanation is given in the slide number 31 at the bottom. So if you, add both, by and large, they will be the same. Some of the traders, because of that Udayam certification, they get reclassified.
Got it, sir. Got it. Yeah. Thank you. Those were my questions.
Thank you. The next question is from the line of Jai Mundra from ICICI Securities Limited. Please go ahead.
Yeah, hi, good evening, sir, and thanks for the opportunity. Sir, a few questions. First is on gold loan, sir. So, this quarter, the last 2 quarters, we have seen a very strong growth in the gold loan book. Earlier, we had, this commentary that we would like to keep it little bit calibrated because we want to grow more of MSME and others. Has anything changed in terms of competition? There were a few players which were, going under a tough period. Is that what has helped you? And you also mentioned that you have increased the yield on the gold book. So, if you can share some further there.
Yeah. See, basically, this is one segment. I mean, as I have been saying in the 2-3 Concall earlier, you started seeing sudden spurt in the unsecured retail consumption loan, particularly for the last 4 to 6 quarters. As you all know, we had not, we are not very gung-ho about the unsecured consumption part per se. So this is one segment. There is a requirement in the market, and which we can't stay away from that. This is point number 1. Point number 2: when we get into the reducing interest rate cycle, you need a portion of your loan book which is in the your fixed interest rate and the short term, and this exactly fit into that thing. So we did some fine tuning on that front, converting the floating rate for gold loan into fixed rate, and also fine tuning the rate depending upon the requirement. And it is now turning out to be that it is helping us to not to go to the riskier segment of unsecured retail at this point of time. At the same time, going towards achieving the targeted growth rate which we missed last year. At the same time, it is giving the stability in the yield, and also in all these matrices it is favorable. And so, and since the demand is also there, we are continuing with this segment.
Right. Okay. Secondly, sir, if you can share this loan mix by benchmark as to how much is MCLR, how much is fixed rate, and how much is repo.
50 is the EBLR. About 30 is the 30-35 is your MCLR. Remaining is your fixed.
So even sir, gold loan is also not the entire 25% of the gold loan is fixed, right?
No, incrementally when they get renewed and the fresh are getting converted. So whatever you entered before taking this call, they will come for review only when they complete the 1 year or the due date for renewal.
Right. So then, as of now, they are floating, right?
Yeah. Since now about 25-30% of them of the gold loan has now got converted. So hopefully, since the rate reduction cycle is also getting postponed, we may be in a position to see maybe half of portfolio or even 50-60% of the portfolio getting converted from the floating rate to the fixed rate, which will give stability to the yield when the decreasing interest rate cycle actually starts.
Right. And secondly, sir, on the launch of the new retail products that we were that we plan to ramp up. In the last 6 months, there has been a lot of change in the macro environment, right? Especially in unsecured and maybe lower ticket size loans. Is there any rethinking in terms of priority, in terms of ramp up of those products, especially LAP and unsecured business loan and unsecured PL maybe?
Yeah, right from the beginning when we started, we were very clear about 2 things. One, we are not entering into the unsecured in a big way. Our entire start in the retail is going to be on the secured retail lending portfolio per se. And 4 to 5 years down the line, it will be about 4 to 5% of the portfolio. The focus will be mainly on the secured lending space. So we are continuing with that. So to start that business, first you need the technology part and all that is ready. You need the senior management team that is by and large ready. The preparation of the policies, writing down the operating manual and all are under progress. Field level staff recruitment are underway. So by the beginning of the 4th quarter, we should be having the executive team for that, field team for that, policies, and also the grassroots level people. Everything will be ready by the beginning of the 4th quarter. So some amount of minor initial progress will be seen in the fourth quarter, but actual, let's say, lineup of growth you will be seeing in the next year.
So the commercial launch is now in fourth quarter, right? And then the ramp up.
It's a soft launch. It's a, let's say, it's a in your sense, the commercial launch will see, and even that commercial launch will be a slow and steady launch only. We will be seeing some amount of minor progress in the fourth quarter.
Right. So, sir, assuming that is not a very meaningful proportion of the incremental growth, you are still confident that the traditional portfolio will drive growth similar to system level at least, right? That is the understanding.
Yeah, that's what I told you. Whatever growth we have achieved at the 12% is from the conventional business mix, whatever we have been doing. So to achieve up to the industry level, closer to that, I don't think we will be facing any challenges. And the secured retail, whatever we are discussing, it will be taking our growth rate beyond the industry level growth rate is what we expect.
Right. And sir, on cost to income, or maybe in other words, from incrementally now onwards, because sir, we had a very low base, right, in terms of cost to income or operating profit. As you said, that last 3, 4, 5, 6 quarters we were continuously running a negative operating profit growth. So at least for the next two quarters, the base is low. But do you think that incrementally the revenue growth, NII plus other income, should outpace the operating expenses, or that is more of the base effect, right? Because the operating profit was not growing actually.
See, the first and the foremost thing is the net interest income. So, and as you have rightly observed, we are just entering into that segment where we see the growth rate in NII and the growth rate in operating profit is positive, where you get income more than the incremental expenditure.
Right.
Thank you. The next question is from the line of Bunty Chawla from IDBI Bank. Please go ahead.
Thank you, sir, for giving the opportunity, and congratulations on this set of numbers. So, as you have previously said, because of this digitization and all, we have improved, we are focusing on the improvement of the TAT on the traditional portfolio like MSME. So if you can share what is the status now and how much improvement is still behind us in next 2 quarters?
Yeah.
In terms of TAT?
See, basically, at least 75 to 80% of the MSME lending less than say 7.5 crore, we are able to make between 3 to 4 days, which is a very big improvement in our let's say compared to whatever we had been doing in the past. So as I told you, from 3 weeks the reduction to 3 days, which is a very big improvement which we have already seen. Some amount of let's say productivity gains we expect from that is that we have to continuously monitor the performance of the portfolio. We have always in any sort of this digital lending, you will be having the cases which are approved by the system, green cases, rejected by the system, amber, red cases, and amber where some amount of manual intervention is needed. We feel we have currently about not less than about 50-60% of the cases are coming for the manual decision making with the input from the system level thing. So we will be increasingly in a position to increase the automated output, which will increase the productivity in the processing front. This will also help us, now only it is now getting set in the branches, the inflows of, the people have started making use of it, particularly from the branches and, MSME vertical per se, in identifying the customers, putting them in the, entering this data into the system and seeing the, the results or output of the system. So the one, as I told you, the improvement in the TAT is very much visible. Number 2, some more improvement in the automation of the decision making can happen in the next 6 months or so, where we have to closely monitor the, performance of the portfolio, maybe fine tune your scorecard depending upon the performance and improve the, more of green and red and less of amber. It will take maybe not less than, 6 months or so. The acceptability at the system is improving, but yet lot of opening of the productivity at the branch level is still pending. So the future quarters, slowly the productivity from the branches should improve, which should improve the disbursement also is what we expect. That is the confidence which make me say that with these existing business lines, we should be getting back to the systemic level growth rate without looking for the newer opportunities.
Thank you, sir. Secondly, on the PCR part, in your opening remarks, you said we are an outlier, so we are focusing on improvement in the PCR. So any specific number we are targeting to achieve by end of FY25 or FY26 in terms of PCR?
We have absolutely, fine PCR when you include the technically written off portion also. But we get...
Ladies and gentlemen, we have lost the management line connection. Please stay connected while we reconnect them. Thank you. Ladies and gentlemen, thank you for patiently holding. We have the management line back on call.
Yeah, looks like it is getting cut every 15th minute, precisely. Did we complete the question or?
Yes, sir.
On PCR, we are completely on track when you include the technically written off portion. So we are getting repeatedly asked, your PCR coverage ratio is low, when we take it purely on the, live coverage. If we just leave probably automatically, as you have seen significant reduction in the, net NPA percentages, that will automatically improve the coverage ratio also to some extent. So I don't have any, as I clearly told you that I want to have between 1 and 1.25% on the net NPA ratio. I don't have any number or anything with me. We will take a call as we, get into the second half.
Thank you, sir. Thank you very much.
Thank you. The next question is from the line of Rakesh Kumar from B&K Securities Limited. Please go ahead.
Yeah, hi. Thank you, sir. Thanks for the opportunity. Sir, one question was related to the restructured book. So the number has come down from 929 crore to 858 crore in the September quarter. So do we have some write back of provision because of that? Because we were holding around 14% provision on this. So would we have any write back of provision on this?
See, about how much when we finalize the annual accounts in the last quarter, we will take a call on the surplus provisions post the completion of that 2-year tenure on restructuring or whatever it is. It's how much write back will be there, how much of that will be provided for the NPA itself. So depending upon the regulations and the recovery happens in the restructured portfolio, that decision will be taken.
Got it, sir. And sir, ROA target, like this quarter we have done 1.6. So what would be the full year target, sir, for this year?
So as we have we have stabilized 1.5% plus. We don't have any specific target on that number.
Got it. Sure, sir. Thanks, sir. Thanks a lot.
Thank you. The next question is from the line of Aviral Jain from Singular Guff and Company. Please go ahead.
Yes, sir, if you could just elaborate more on the plans that you have been mentioning. First is on other retail products which are secured in nature, such as housing, LAP, vehicles. And then there was one more line of business regarding co-lending and lending to NBFCs. So if you could just elaborate in the next 2 to 3 years plan as to how do you envisage that building up. I remember you had mentioned that this all put together would be 15% of the overall loan book at that time in 3 years' time. So how is the progress on each of these initiatives?
No. I don't think we started about 15% number and all. It was very much less than 10 only. If I distinctly correct, maybe 7-8% of our staff. Basically, for co-lending and the onward lending, direct lending to NBFC is continuing. Maybe once we are able to see good growth in our conventional thing, we may have to slowly fine-tune that depending upon the requirement. So the technology, whatever that is needed for the co-lending and all are already with us now. So those things going forward, how the other factor both secured retail and co-lending and all, now Vijayanand will give you some feedback.
So we will go with secured as planned for Q4 beginning. There is no change on LAP, home loans and affordable and micro LAP. The technology is ready and we just need feet on street, which should ideally be there in Q3. With respect to co-lending, we have technology. We will use it basis what is the numbers which we are building in our retail model. Then we will take a call accordingly.
And this would be the own sourced book would be through by cross-selling to existing customers, or within retail you would go out and look for sourcing customers outside the existing customer base of the bank?
We will have new to bank customers for retail also. We will also have new to bank customers. Predominantly, we will use our employee sourcing in South, our branch sourcing in South, and basis our presence. For North and West, we may use third party.
Which would mean DSS?
Yeah.
Okay. And on co-lending, what sort of products would those be? I'm assuming those would be something that the bank would not be choosing to do in-house.
If at all we do co-lending, it will be only secured.
Okay, but this would be vehicle finance or...
LAP.
Okay, primarily
loan against property. And some sort of HL if required.
Sure. And at a steady state, say, since you would start by Q4 FY25, next year, basis the cost base that has been built in for such initiatives, what sort of loan book would you be targeting so as to make it, in terms of profitability, neutral for the bank?
Yeah, it will be about 2 to 3% in the financial year 25-26. So we gave you that we should be having about 7-8% in the next 3-4 year time frame. It could be around, let's say, 2%, 2% for the these sort of other initiatives to support us. And I don't know. Yeah, I don't know whether you remember another data which I came in the earlier Concalls. Let's say out of our 45 to 50,000 crores of whatever loan book we have, our customers have taken about 7,000 odd crore worth of these products from the other financial institutions, So the deepening will be the, first action in making our existing customers to probably, get that converted from other institution to us.
Sure. And while I understand that large portion could be new to, existing customers, but cost base to service retail would be high, given lower ticket sizes. So I'm assuming this would be at a higher interest rate than what the current core business is at, from a spread perspective over your cost of funds.
So we will be on par with the market. So that's the reason why I mentioned this. In South, I will not use my third-party sourcing, and North and West is going to be third-party sourcing. So my branch distribution in South should take care of my retail business, which comes with zero cost or very negligible cost. In North and West, we use a third party, which should give me the blended average. So from the cost perspective, we ensure that we manage it tightly from the retail for the retail products.
Sure.
Today we have a 550 odd branches in South, which should give me a good retail business for the bank sourcing and feet on street floating. I don't need to use my third party majorly in South.
Sure. And what's the fixed cost base addition that has been made for this initiative?
I think in fact, I explained in the last Concall, how much we made to BCG and how much elbow room it is giving that amount of investment for us is what I gave you in a couple of, quarters back. So you will be having around about 30-35 crores will be by and large the incremental business expenditure, which is already to greater part is observed in the overall scheme of things. I even clearly explained that you will have loss in the first year. It will break even in the second year, and the profitability and accretion to the ROA will start coming only from the third year. By and large, we are on track for in that direction.
Got it. Thank you so much, sir. This really was helpful.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you all for taking this Concall. As we explained, we are able to get into the cycle where we have started seeing both operating profit and NII started taking a positive tenure. Growth has also firmed up with, more than, double digits in the last couple of, quarters. So, and this growth has come basically from our conventional, businesses and without adding any, business from the retail, whatever we explained as we explained. So, and the overall ROA of 1.5% and all metrics have, properly settled. So overall, we said that we should be having about 800 crore because we had about 1,200 crore NP addition 2 years back, which got down to 1,000 crore for the financial year 24, and this year we said we will be having about less than around 800 crore or less than 800 crore or sort of. So on all these things, whatever we said, we are on track, and there is a good amount of improvement in the overall scheme of things. The net NPA has also decreased by about 25 basis points in this quarter, and 5% growth in deposits and 5% growth in the credit has also happened in the second quarter. So all these things are giving enough confidence that, the things are on track, and we should be able to have, better, second half. With this, I request all of you to probably, if you have any more questions, you can get in touch with as per the list, contacts given in the report, investor presentation. Once again, thank you all for participating, and like I request your continued support going forward. Thank you all. Thank you.